Biggest risk to agriculture right now might not be drought, it might not be exports, and it might not even be cattle prices. It might be a narrow strip of water halfway around the world. Over the weekend, shipping through one of the most important energy corridors on Earth slowed dramatically as tensions tied to Iran escalated. Tankers are rerouting, insurance costs are jumping, and crude oil prices surged more than $10. That kind of move sends signals across the entire global economy. Because when oil spikes, three things often follow close behind: fuel, fertilizer, and the cost of moving food around the world. At the same time, parts of the United States are watching drought deepen just weeks before planting season, while cattle futures ended the week sharply lower. So the question this morning isn't just where prices are, it's whether these pressures are temporary or the early signals of a bigger squeeze developing across farm margins. Good morning and welcome to Boots and Bushels, your daily look at the markets that feed America. Each morning we map out the pressure points shaping agriculture using where futures were last trading near late in the previous session. This isn't advice, it's awareness. Today we're looking at four major forces shaping the week ahead: grain markets holding together, cattle taking a noticeable hit, weather risk expanding in parts of the plains, and geopolitical tensions that could ripple through energy, fertilizer, and global food logistics. Let's start with grains. Corn futures were last trading near 460 and 3/4, up roughly 7 cents. The move higher isn't dramatic, but it does suggest traders are becoming cautious about risk heading into planting season. Corn markets are especially sensitive to fertilizer costs because nitrogen is one of the largest inputs required for production. If fertilizer markets tighten, which could happen if shipping disruptions develop in the Middle East, corn margins are usually the first place the pressure shows up. For now, the board is holding steady, but producers are watching input costs just as closely as the futures screen. Soybeans were last trading near 1201 and 3/4, up about 22 cents. Beans have been finding support from strong crush demand and steady global vegetable oil markets. But there's another factor developing that traders are starting to watch: freight cost. If shipping routes become unstable or more expensive, that can reshape how soybeans move around the world. Higher freight costs sometimes shift trade flows, especially shipments moving into Asia. For now, soybeans remain firm, but global logistics are quietly becoming part of the story. Wheat markets remain sensitive to weather and export competition. European wheat spread markets were trading near $17 equivalent, down modestly. Wheat is one of the most globally traded crops on Earth, which means it often reacts quickly when freight routes or shipping costs change. If transportation becomes more expensive or uncertain, wheat markets are often among the first to show volatility. Oat futures were trading near 339 and a quarter, up about 5 cents. Oats are a thinner market compared to corn and soybeans, but they tend to move quickly when broader grain sentiment shifts. For now, the move appears tied to general grain strength rather than specific fundamental change. Now let's shift to livestock, where the tone was noticeably weaker. Feeder cattle futures were trading near $347.93, down roughly 760. That is a significant move lower for the feeder market. Feeder cattle are extremely sensitive to feed cost. When corn prices begin moving higher, or when uncertainty grows around feed expenses, feeder cattle futures tend to react quickly. Some of the selling may simply reflect profit taking after a historically strong run, but it also highlights how tightly cattle margins are tied to grain markets. Live cattle futures were trading near $234.33, down about 420. The cattle market has been remarkably strong over the past year thanks to tight herd numbers and steady demand. But when volatility shows up in feed costs or broader commodity markets, cattle can experience sharp corrections. Producers will be watching whether moves turn into short-term pullback or something more persistent. Lean hog futures were trading near 95.68, essentially unchanged. Hogs have been trading in a narrower range compared to cattle. Export demand and domestic consumption remain the primary drivers here. Energy markets delivered one of the biggest moves of the week. The WTI crude oil was last trading near 91.27, up more than $10. That kind of move rarely happens without a major catalyst, and the catalyst this time is geopolitical tension. Before we get deeper into geopolitical story, let's talk about weather because it continues to shape risks across agriculture. Parts of the central and southern plains remain under developing drought conditions. Areas of concern include Kansas, Nebraska, Oklahoma, and Texas. Some regions are already experiencing moderate to severe drought levels. This matters for several reasons. Winter wheat relies heavily on moisture through the spring to finish development. Pasture conditions for cattle operations also depend on early season rainfall. If drought persists, producers could see pressure on both crop yields and grazing conditions. Dry conditions in the southern plains can also affect cattle markets. When pasture growth slows, producers sometimes need to rely more heavily on feed. That increases demand for grain and can tighten margins across livestock operations. It's one of the many ways weather quietly influences multiple markets at once. Meanwhile, much of the Midwest has seen more balanced soil moisture conditions recently. That provides some of the stability heading toward planting season. But meteorologists are closely watching the transition away from La Nina conditions toward a neutral pattern. When the Pacific moves into a neutral phase, weather patterns can become less predictable. That means producers may see larger swings in weather conditions later this growing season. Now let's turn to the biggest geopolitical developments affecting agriculture right now. Over the weekend, conflict tied to Iran escalated in ways that directly affected global energy markets. Shipping activity slowed through the Strait of Hormuz, one of the most important waterways in the world. This narrow passage connects the Persian Gulf to global shipping lanes. Roughly one-fifth of the world's oil supply normally moves through this corridor. When security risks rise in that region, tanker traffic often slows as companies reroute ships or wait for safer conditions. That is exactly what appears to be happening now. Oil prices surged in response. The second layer of the story involves fertilizer. The Persian Gulf region exports enormous volumes of ammonia, urea, nitrogen fertilizer feedstocks. If shipping disruptions slow exports from that region, fertilizer supplies tighten globally. Nitrogen fertilizer is one of the largest input costs for corn production. That means disruption in fertilizer markets can quickly translate into pressure on farm margins. Corn producers, especially, fertilizer costs are often the single largest variable expense. There's another piece many people overlook. Nitrogen fertilizer is produced using natural gas. Natural gas is both a feedstock and an energy source for fertilizer production. When energy markets become volatile, fertilizer production costs can rise. If crude oil and natural gas markets remain elevated, fertilizer manufacturers may face higher operating costs. That pressure eventually flows downstream to producers purchasing inputs. The third piece of the puzzle is global food logistics. When major shipping routes become unstable, freight companies adjust quickly. Ships reroute, insurance costs increase, and transportation becomes more expensive. When that happens, the cost of moving grain, feed, ingredients, and vegetable oils around the world increases. We've seen this before during the pandemic supply chain disruptions and during the Black Sea shipping crisis after Russia invaded Ukraine. Whenever transportation systems tighten, agricultural markets tend to become more volatile. So as the new week begins, agriculture is facing several overlapping pressure points. Grain markets are holding steady for now. Cattle futures pulled back sharply. Weather risks remain present in parts of the plains, and global tensions are beginning to ripple into energy markets and shipping routes. Those forces may seem distant from the farm gate, but when energy, fertilizer, and transportation costs start moving, the effects can eventually reach every producer. We'll keep watching how these stories evolve throughout the week. Thanks for joining me for Boots and Bushels, the markets that feed America.